Picture this. It's December 2025, and silver prices have just smashed through $58 an ounce, a level that would have seemed insane just a couple of years ago. But here we are, in the middle of what experts are calling the biggest commodity squeeze in decades. Solar panels are being installed at record rates across rooftops in Europe and the US, electric vehicles are flying off production lines faster than ever, and 5G towers are popping up everywhere, all hungry for one critical metal: silver. And guess what? We're not just running low. We're in a full-blown deficit that's been building for years. But there's something even more explosive lurking beneath the surface, a convergence of forces that could send prices to $100 or more. I'll reveal exactly what that is later in this video. But first, let's unpack how we got here and why this could be the opportunity of a lifetime, or a warning sign for bigger economic trouble ahead. You know, I first got hooked on this story back in early 2024, when silver was hovering around $30 an ounce. I was digging through reports from the Silver Institute, and something jumped out at me. Global demand was already outpacing supply by hundreds of millions of ounces, and projections for solar alone were mind-blowing. Fast forward to now, December 2025, and those predictions have become reality. Silver has surged over 71% this year, outpacing even gold's impressive 54% gain. Mine production? It's been declining, stuck around 830 million ounces, way below the peaks we saw back in 2016. Why does this matter to you? Because if you're invested in tech stocks, renewable energy, or even just worried about inflation eating away at your savings, silver's story is your story. It's the metal that's both an industrial powerhouse and a safe haven, and right now, it's screaming for attention. But wait, before we dive deeper, let me ask you this. Have you ever wondered why silver, of all things, is at the heart of the clean energy revolution? It's not just a shiny trinket. In solar panels, silver paste is irreplaceable for conducting electricity efficiently. Each megawatt of solar power needs about 20 grams of silver, and with the International Energy Agency forecasting over 400 gigawatts installed annually by 2025, that's pushing demand to 200 million ounces just for solar. Electric vehicles use twice as much silver as traditional cars, for everything from wiring to batteries. And 5G? Those networks require silver in antennas and chips to handle high-speed data without overheating. Add in medical devices, electronics, and even water purification, and industrial demand hit a record 680.5 million ounces last year, with 2025 on track to beat that. The numbers are staggering, but they're real, and they're driving prices up because supply can't keep pace. This isn't my first rodeo with commodities. I've followed markets for over a decade, and patterns like this don't lie. Remember the oil shock of the 1970s? It started with complacency after World War II, when oil was dirt cheap at $3 a barrel. Everyone built their lives around it. Suburbs, cars, the whole post-war boom. Then demand exploded as Europe rebuilt, and car ownership soared. But U.S. production peaked in 1970, and new supplies like the North Sea fields were years away. Suddenly, the Yom Kippur War triggered an embargo, and prices quadrupled overnight. Gas lines stretched for blocks, inflation hit double digits, and economies ground to a halt. By 1980, oil was at $35 a barrel, a tenfold increase. That wasn't just politics. It was the brutal math of supply and demand clashing. Or take something darker, like the Irish potato famine in the 1840s. Ireland's population relied on potatoes as their staple food. Cheap, abundant, taken for granted. Then blight hit in 1845, wiping out 40% of the crop in one season. Wheat was available elsewhere, but prices spiked so hard that the poor couldn't afford it. It wasn't a total food shortage. It was a price dislocation that made existing supplies inaccessible. The result? 1 million dead from starvation, 2 million emigrated, and Ireland's population dropped 25%. Wheat prices stayed high for years, showing how quickly a supply crisis can turn deadly when it hits essentials. Fast forward to something more modern, the palladium surge in the 2000s. In the 90s, it was cheap and ignored. Then, emissions regulations tightened worldwide, making palladium essential for catalytic converters in cars. Demand jumped, but supply was inelastic. It's mostly a byproduct of other mining. By 2019, we'd had 8 years of deficits. Inventories vanished, and Russia, controlling 40% of supply, had no reason to flood the market. Prices went from $500 an ounce in 2016 to $3,000 by 2020, a six-fold rise in 4 years. Automakers had to switch to platinum at huge costs, losing efficiency. Again, the pattern: complacency, surging demand, recognition of deficit, then panic. Now, applying this to silver in 2025, it's like watching history repeat in real time. Stage 1, complacency, has been our reality for 40 years. Silver was absurdly cheap, cheaper in inflation-adjusted terms than in 1980. Massive mines developed, governments sold off reserves, and we all treated it like an afterthought. But stage 2 hit hard around 2010, when solar took off from negligible to the fastest growing energy source. Electric vehicles followed, with sales exploding globally. 5G rolled out, demanding more silver for infrastructure. Industrial consumption doubled in under a decade, reaching over 1 billion ounces needed yearly, while mine output peaked at 880 million in 2015 and has been flat or falling since. 70% of silver comes as a byproduct from zinc, lead, and copper mines, so you can't just ramp up silver production independently. Base metal prices are volatile, and mining investments are at multi-decade lows. No new major supplies are coming online anytime soon. And this is where everything changed. We're firmly in stage 3 now, recognition of the structural deficit. Global inventories on exchanges have plummeted 60% in 4 years, with COMEX down to under 60 million ounces, less than 3 weeks of global consumption. The Silver Institute reports 5 consecutive years of deficit, with 2025 marking another record. Physical premiums are rising, delivery times stretching out. In Shanghai, inventories hit their lowest in nearly a decade, and borrowing costs for silver are spiking. Industrial users, from solar manufacturers to defense contractors, are stockpiling quietly. This isn't hype. It's happening right now, in real time. But there's one thing I haven't mentioned yet. A twist in the silver story that's making this crisis unique compared to oil or palladium. Hold on to that thought, because it's going to tie everything together. First, let's talk about what stage 4 could look like. Panic. It starts with a major announcement. Maybe a big solar company like First Solar or an EV giant like Tesla saying they can't source enough silver for production. That sparks a cascade. Other firms rush to buy, governments step in to secure supplies for strategic industries, and investors pile in, remembering silver's 5,000-year history as money. Prices don't climb steadily. They gap up 50, 75, $100 an ounce. Analysts are already forecasting 65 to 67 by late 2026, but that could be conservative if panic hits. Can you guess how this plays out in your daily life? Higher costs for solar installations, pricier EVs, even more expensive electronics. But for investors, it's a bonanza. I started positioning myself back in 2024, buying physical silver and mining stocks. By mid-2025, my portfolio was up 30%, then 50%, as prices broke records at 54.47 an ounce in November. Not financial advice, just my experience. But it shows the potential when you spot the pattern early. People always counter with, won't technology save us? Substitution, recycling, new mines? I investigated that thoroughly. In solar, no substitute matches silver's efficiency. Copper oxidizes too quickly. Aluminum doesn't conduct well enough. You can't cheat the periodic table. Recycling? From electronics, it's below 20% efficient, and solar panels tie up silver for 25 years. New mines take 7 to 10 years to develop, and global grades are declining. Demand destruction? Only if the energy transition halts. But with trillions in subsidies and mandates across the US, EU, and China, that's not happening. Policies don't bend to commodity prices. They push forward regardless. Remember the 1970s? The US, the world's superpower with the reserve currency, was humbled by oil shortages, gas rationing, stagflation, a lost decade. Power doesn't trump geology. Silver is finite, and we're consuming it faster than we extract. The deficit for 2025 is projected at around 200 million ounces, the 5th straight year. Industrial demand might dip 4% to 1.12 billion ounces, but that's still way above supply. And here's where it gets interesting. That hidden twist I mentioned, it's the monetary angle amplified by 2025's economic turmoil. Silver isn't just industrial, it's money. With fiat currencies debasing amid high debt and inflation, investors are fleeing to hard assets. Gold's up, but silver's volatility makes it the leveraged play. In 2025, as geopolitical tensions rose and U.S. policies shifted under new leadership, silver became the go-to hedge. Combine that with the industrial squeeze, and you have a perfect storm. That's the convergence, tech demand meeting monetary fear. It's why silver's up 95% this year while gold's at 62. But let's expand on more examples to drive this home. Think about the uranium boom in the 2000s. After years of low prices post-Cold War, nuclear power demand surged in Asia. Supply was tight, mines shuttered. Prices went from $10 a pound to $137 by 2007, or lithium in the 2010s as EVs took off, from $3,000 a ton to $80,000 by 2022. These cycles follow the same 4 stages, and silver's no different. In my journey tracking this, I interviewed a mining executive anonymously. He told me, off record, that major copper mines are prioritizing base metals over silver byproducts because margins are better. That's squeezing supply further. And reports from Kitco show silver's divergent path from gold, gaining perceived value as deficits mount. Physical markets are decoupling from paper ones, with premiums on coins and bars hitting 10% or more. What about the skeptics? Some say the deficit will ease with slower economic growth, but even with a 4% drop in demand, the gap persists. Others point to recycling improvements, but rates are stuck low. And exploration? Funding's down, with no big discoveries on the horizon. Let's zoom in on solar. Photovoltaic consumption set another record in 2025, despite overall industrial dips. China leads, but the US and Europe are catching up with incentives like the Inflation Reduction Act. EVs? Global sales hit 20 million units, each using extra silver. 5G infrastructure? Billions invested, with silver in every base station. Now, for the climax, that primary mystery. The explosive force? It's the silver squeeze potential. With inventories critically low, like Shanghai's decade low, a short squeeze could mirror the GameStop frenzy but in metals. Paper contracts outnumber physical 100 to 1, and if deliveries are demanded, prices detonate. We've seen hints in early 2025 with unusual silver flows into the US. That's the payoff. Not just shortage, but market mechanics breaking. So, what's the takeaway? This isn't doom and gloom. It's pattern recognition. Silver's at the intersection of energy transition, tech boom, and monetary reset. For 2026, forecasts see prices at 40 to 100, depending on panic levels. Verify yourself. Check Silver Institute reports, IEA forecasts, COMEX data. It's public. If this opened your eyes, subscribe, hit notifications. Next video, how paper manipulation held silver down for decades and why it's crumbling now. Don't miss the wealth transfer.